What can you do to avoid mistakes when investing in your retirement?
Are you a working professional but struggling to balance the workload of your career, family, obligations, and preparing for your financial future? If so, this podcast is for you. You've spent years learning your craft, and now it's time to focus on your financial future. This podcast will teach you what you need to retire wealthy and happy. Let's dive in.
Welcome to the Retire Wealthy and Happy podcast. Good morning, Earl. Today we have with us the incredible Sandhya Seshadri. Sandy is an apartment syndicator from Texas. She helps people go from Wall Street to Main Street. Good morning, Sandhya. How are you today?
Doing great. Thank you so much for having me on your podcast, Roger and Earl. It's such a pleasure to be here.
Good morning. Hey, we're excited to have you. I'm really excited to hear about how you got started in the apartment investing. I don't think you started as a real estate investor. You started someplace else in the corporate world, and we're really excited to hear your story about how you got started.
Yeah, like most Asian geeks, I have a strong math background. I was an engineer in the corporate world doing my engineering job and realized very quickly that all the marketing, sales, business types were making decisions for us. So my company was kind enough to pay for me to get a part-time MBA while I worked full-time for them. And that's where I understood numbers and financials, et cetera, and began truly investing in the stock market with investor clubs, et cetera, even to some extent day trading and so on. And many years later, once I had children, I went full-time into the stock market because I got to pick my schedule without the rush of 10, 12-hour days and travels of corporate America. I always wanted to have something to do with real estate, but I did not have a handy person background. And I felt like, a handyman could come and pretty much tell me it's going to cost me $1,200 to get something fixed, when in fact it may only cost $200. So I was always afraid to do that. And when I analyzed the numbers for, single family rentals in Dallas, the margins were only in the range of $200 to $300. And I felt like I would easily lose that just from a tenant not paying rent for a month or, in between switching tenants. Felt like I could easily make that money with the stock market. So when a friend told me that I could do large scale multifamily where I would be an asset manager and I could employ property management staff on site, full-time maintenance, full-time leasing manager, etc., I could avoid all of the hassles of tenants, toilets, trash, and termites, the 4 T's. And I would be a project manager like an asset manager, which is what I've done in the corporate world. So that made sense. And since I had quit my corporate job, I had all my retirement money still in a 401k type of funds that I was able to roll into a self-deducted IRA and start by investing passively. And the analogy I use is before you become the pilot of a plane, try being a passenger in a plane. And that's exactly what it is to invest passively with retirement funds that I couldn't really put into my own deals. And that way I established relationship with sponsors. And then eventually I was able to be a general partner myself and be one of the 3 general partners on a deal in Dallas. And that's how I got started with being a syndicator.
Very, very cool. You said earlier that you could become active investor, but still avoid all of the toilets and the trash and all of that kind of stuff. Has that really actually been the case, or do you
Yes.
find yourself getting it? Is that really true?
Yeah, property management company does most of the day-to-day hassles. I don't get called when a tenant has a leaky toilet. That's handled by the on-site staff, et cetera. I do know that, when we get involved in, say, doing a water conservation schedule, then I do get to talk about toilets or, take pictures with toilets. But it's a water conservation company that comes in and installs like 200 toilets across the apartment complex. But I don't get involved in the day-to-day work orders, the maintenance orders that people would otherwise get called in a single-family rental. Or you could employ, even in a single-family rental, a property management company, but you lose quite a bit of margin.
Yeah. So my background is I started out of college with an internship with an IRM property management company, and I spent 15 plus years working my way up to at one point I was the VP of a publicly traded REIT. We do a lot of apartments today, and Roger and I both sit back and laugh that my goal from the time I got started in property management was to not have to chase criminals out of my apartments and to not have to change toilets. And I think as much as we have tried to distance ourselves from it, I don't actually get down and change the toilets myself, but I seem to get involved in a lot of that. And I think Roger, but it's probably because most of everything we're doing is full rehab on our apartments, and so we end up getting involved in it. We do insulate ourselves quite a bit from it. I don't get that call on Christmas Eve anymore that my toilet's plugged, but we do find ourselves very, very active in property management, so to speak, or at least talking to property managers. So
we have weekly calls. Go ahead.
So I'm dying here laughing because we talk about tenants, toilets, and trash a lot. And last night, I have a duplex that I own, not part of the syndications at all, but last night around 9:00, one of my toilets blew up. I've got a duplex that has a clogged sewer.
Ooh.
And so they ended up going through one side that was vacant through the toilet hole. And rather than going down the sewer line to the street, they came up into the toilet and blew it up just last night. Like, you're not going to get away from the tenants, toilets, and trash, but you can definitely not get that call. So, yeah. Tell me, Sandhya, how many years ago was your first passive investment?
A little over 4 years ago, about 4.5 years ago, is when I did my first passive investment. And about 8 months after that, I was, under contract for a syndication. And one of the ways I found my partners for that, my first deal was 86 doors. And I found partners who are located out of state, but who had the experience to run properties in the past. They had done small single family, small multifamily, and they wanted to get into the Texas market. And so they knew what they were doing. They didn't really need my help, but I kind of chased after them and said, listen, I'm here, I'm local. You can just put me to work and I'll do all the work. You have to make fewer trips here. And this way I'll learn all the ropes. And that's how I got my first deal as a general partner, is by offering to be the boots on the ground.
What part of Texas are you in?
I'm in Dallas. Cool. And I've lived here for 32 years. So all my deals, my general partnership deals where I'm in the asset management side, are within a 30-minute drive of my house. So I really know my local market well.
Do you normally is it South Dallas that you're doing stuff in, or what part of Dallas are you finding your stuff in?
I avoid South Dallas, actually, but I know all my other places. So I do a lot of the suburbs. Irving is a popular area. I have 2 properties there. I have Carrollton, Garland, Hearst, which is one of the mid-cities between Dallas and Fort Worth. So I know all my sort of good places. And the way I choose them is, do I feel safe getting down from my car and walking around that apartment complex when it's dark at night? And that's one of my criteria. I avoid areas with high crime, and I want to make sure the median household income in those locations can support the rents that I'm planning. So if my rent is going to be $1,500 times 12, you're already at $18,000. So 18,000 times 3 is $54K. So I make sure the median income in that area can support my rents. Otherwise, you're going to end up with a lot of delinquency. So if the median income is $36K, that's going to be too low.
Roger and I both speak at some RIA clubs, and that's one of the criteria that we use to teach people how to analyze a market, is that specific thing. If you're looking at the average home price and it doesn't correlate, your median income needs to be about 25% of the median home price, right? For every 100,000, you're looking at 25,000 a year minimum. And if you don't have that, then the average person can't afford it. And it works the same way with apartments and rent. If your average person is not able to afford the rent, then you're going to have a lot of delinquency and a lot of vacancy, that type of thing. So that is really, really solid advice. I'm curious. We use the 1% rule quite a bit also in going in. Do you use that also when you're first looking at your deals?
I don't specifically use the 1% rule, but I do make sure that the rents at the subject property are significantly below market of similar comparable properties within a 1 mile radius, meaning it's a B class, you compare it to a B class, and that's by vintage. So B class is something built in the 80s and newer, C class is, 70s, and then A class is more new. So you want to make sure when you compare the rents of your subject property to another property nearby that it's apples to apples comparison. And the subject property has to have rents far below market so that we don't have to do a huge amount of platinum style of upgrades and fancy things to, increase the rents by $75 to $100. There's a basic organic growth already built in of $7,500 at least per door.
My rule of thumb is most of the deals we do, if I can't raise the rent $200 a month, I'm probably not interested in looking at the deal. And so we spend a lot of time focusing on how far below market our rents are. And then you have to figure on the back end, how much can I spend to bring that up there and make sure that the two work. It sounds like you do a lot of the underwriting for your team. Is that right? With your math background?
Yeah, I love underwriting, but I also have engineers on my team. So sometimes my partner will underwrite a deal and then I'll independently underwrite it as well. And then I like to do my drive-by in the day as well as night and check it out. So once all the physical things check, then we actually deep dive into the deal. The first one is just basic address and zip code, having lived here 32 years. If I have an address, I already know if I'm even slightly interested. And then the other thing is just from having so many deals that, either I'm passive or active or I have a large network of people. I know my price per door for a property. Let's say it's an 80s vintage and it's in Plano versus South Dallas. I already know what I should be paying per door. So a lot of initial screening criteria helps me weed out more than 90% of the deals that, come by. And that helps a lot. But I do underwriting. I have to underwrite my own deals, even if a partner underwrites it.
I'm curious, by the way. I used to I used to go into Dallas quite a bit. A couple of the companies that I've worked for. The REIT was headquartered there in Addison. And Fairfield Development had one of our two offices. I was in the San Diego office, but they used to take us in about every 6 months to usually to Fort Worth. We'd go over to the stockyards and have a company party over there at the stockyards. But within the last 3 or 4 years, I used to fly in about once a month. I had a couple of partners that were there in Dallas, and I would fly in and speak to raise money for the group. I absolutely love Dallas. I think it is an absolute incredible market out there. I'm curious, are you finding deals in Dallas that are is it a little more difficult to find deals than it was 4 years ago when you got started, or how are you seeing the market transition out there?
I think just in general, we're now in April 2023. The rising interest rates has definitely slowed it down. But as far as being awarded deals and finding deals, like let's say a year and a half ago, early 2022, if you will, there were plenty of deal flow. There were tons of deals coming through the pipeline. And I think you'll start seeing that again, especially with all the floating rate loans that are coming to maturity or needing an extension and may not get it from the lender. There's the gap between what a seller is hoping to get for their property versus what a buyer is able to afford because of the lending terms. That gap is narrowing more and more. So I think you're going to have a lot more deal flow. But as far as getting awarded the deals, once you've done a few deals, the brokers know you. And being a very competitive and large market, it is controlled by a lot of the major brokers. So, I've done a deal with probably every major broker in the Dallas area. So in that sense, we have our name established to get these deals awarded. If you can come to that whisper price, right? And if that whisper price is reasonable and I love the deal and it's a great location, like, a broker told me about this deal in Garland that's about 4.5 miles from where I live. And I was like, oh, I'm going to go after that. I want that deal. Right. So you can do that once you have that connection.
Very good. Yeah. Roger?
How many deals have you done in total in Houston?
All my deals are in Dallas. And as a general partner, I've been in 9 deals so far. But as a limited partner or passive investor, it's like more than 20 deals because I put my retirement money into other people's deals. And it helps me network with other general partners. It also helps me to get to know those deals in case I want to be the buyer when it comes up for sale.
That's awesome. 29 deals is huge.
Mm-hmm. Yeah.
So we met, or we were at the Best Ever conference a couple of weeks ago. Was it 6-8 weeks ago, something like that? And there was kind of a shock to the system out there. when one of the speakers stood up and said, basically, the market is changing, and probably 20% of you guys will not be here in the room next year because of what you talked about, those the changing interest rates, the variable rate loans, syndicators that haven't been really careful about how they've underwritten their deal. And you were there and actually helped an investor to avoid getting involved in one of those marginal deals, so to speak. Tell us a little bit about that.
So actually, it was about a year and a half ago. I'm part of a larger mentoring program in Dallas. And so we periodically have these bus tours and networking events. And there was a relatively new student who had just joined the group, and he had heard about one of these large deals in Houston to the tune of 700, 800 plus doors. And I had also received my email about that deal because I know that sponsor. I have actually passively invested with that same sponsor on a different deal with several other co-sponsors. And that deal is located around the corner from my house, so I know it's a great location. But this was a Houston deal. It was more than 700 doors. And I had looked at the crime stats for that area. And I said, based on the crime stats and the median household income and just the general reviews of that property, I would stay away from it. So I didn't actually dig deep into the numbers. I just looked at the basic location stats for that property and said, this seems more risky. I wouldn't get into something that's in a bad area because syndicators tend to do short cycles, 3 to 5 years kind of cycles. And you can't really change the crime in a particular area. The most you could do is your own apartment. You could secure it with some security gates, armed patrol, etc. But if that neighborhood itself is kind of having more of the crime issues, murder, stabbing, drug lords, and all of that, then it's going to be hard to invite the right kind of residents into your property. So I generally stay away from high crime areas. And that's what I pointed out to this investor, who then made the decision afterwards, after further deliberations, to not put his hard-earned money into those deals. And that was one of the 4 deals that just foreclosed 2 weeks ago in Houston by Arbor, the lender. And it turns out that the reason those deals foreclosed, the primary reason, is they were over-leveraged, over 80% leverage, an additional 10% of private equity money, and there was no rate cap purchased. When you buy a floating rate loan, you need that insurance, like a ceiling of the maximum interest rate. You should be paying for it. And because of the high crime in those areas, they were hard to keep it occupied with paying residents. And then the property management company went out of business. So several things factored into it. The primary factor was highly leveraged bridge loan, floating rate loan without a cap. And that's why the deals folded and foreclosed. They couldn't pay the mortgage for several months, and then they foreclosed.
And to add to the story, you not only saved that investor the initial cash investment, but there was also a IRS tax burden. You want to explain that?
The IRS tax burden?
Yeah, you get a recapture tax when the IRS forecloses, or when the property goes through a foreclosure, the IRS taxes you above and beyond that.
I think it depends on how much money was lost in the deal. And accordingly, I think that's a specific accountant question. But depending on how much money is lost, if your $100,000 investment, let's say in the deal, ended up at zero, I don't think you would have to pay any tax on that. That's my understanding.
I've had a little experience with this. Years ago, we were doing. I was an RTC contractor years ago, back in the early 90s. Or worked for an RTC contractor out of college. And I sat in, a guy had syndicated, probably 15,000 apartment units. He was a CPA himself. He taught school in Berkeley, actually. He taught accounting. And I sat there with this man, and he was almost in tears as he said, that they had loans that they were 10-year loans, but the value of the building had come down to the point that they couldn't roll their loans over and they couldn't redo them. He said the recapture tax, when your apartment gets foreclosed on, they actually the IRS says it's a forgiveness of loan. So not only do you lose that $20 million asset and you don't have the income to pay the taxes on that going forward, they also say that $20 million is instant income. And you take that by 15,000 apartment units. And the guy was like, he's in his mid 60s. He was, basically for all intents purposes retired. And he said, this will wipe me out and my family. And, so people don't, I think people don't understand the gravity of letting one of these deals go bad. Once that foreclosure starts to happen, you lose complete control of your financial situation, and that's just the IRS situation, and it doesn't even come close to I'm sure that the SEC, these guys were all raising money through Reg D. I'm sure the SEC is going to have something to say about being more careful about how you operate your deals. So,
I bet.
Anyway, Roger and I had an experience just a little while ago. A very good friend of ours who just recently decided to get into syndicating and apartments, and they sent the first deal out. And because I'm on his list, I got a copy of it, and we gave it to, passed it around, looked at the deal to rate it. And I'm like, this checks, this looks good. It's got plenty of rent, got this, it's got all these things that checked off. And then I looked at the reversionary cap rate. That's going to determine what you're going to sell this thing for. And this was just at the beginning when interest rates were starting. And we knew, everybody knew that interest rates couldn't stay at 3.5% or 4% when you've got 15 to 20% inflation. It's just impossible. But he had a 3.5% or 4% reversionary cap rate on this thing 2 years out. And you've done enough of these. You're like, holy smokes, there is, people will be lucky to get any money back out of this thing, let alone, after they spend, $20,000 a unit to fix it up, but they can't sell it for anywhere near what they have into it. So it's very interesting that you spend a little time in the business and you start to see that people are cutting corners and honestly, I think it's just getting started and not knowing enough in advance to realize the full gravity of what they're doing. So it's really nice to talk to somebody that actually has that. Hey, I've done this. I've done this enough. I know what I'm looking for. I'm really, really cautious because, man, one bad deal can give the whole industry a black eye, so to speak. So,
yeah, I think that was highly publicized, that foreclosure, and there were so many warning signs before you get to that stage. I mean, when your DSCR, debt service coverage ratio, is less than 1, meaning it's like you get paychecks at home and you need those paychecks to cover the mortgage payment. You don't have it.
Yep.
Your net operating income is not enough to pay the mortgage. That's the first sign of trouble. So you start right there to do something about it. You bring additional capital, you start working with the lender, etc. Before you get to the point where, I can't pay the mortgage and you're going to foreclose. There's warning signs before that. But yes, an exit cap or a reversion cap, which is going to be a prediction of the future. So what will the cap rates be in 3 to 5 years when I'm getting ready to sell this project? You base that on first the entry cap today, and then you conservatively assume anywhere from a third to a half additional cap rate for every year of hold. So if today you're buying a deal at a 5 cap, 5.5 cap, and you want to sell it in 5 years, I would assume a 7.5 cap. And that's a very conservative estimate. And if the deal still pencils on that cap rate, assuming all the other assumptions are verified by a neutral third party, then it might be a really good deal, assuming it passes the location test. Never miss the location test. Real estate is still all about location. But one of the most important things is sponsors, general partners tend to favor certain numbers over others just to make the deal work. And it's very important to get these numbers from unbiased sources. So the lender gives you a term sheet that you would plug into the underwriting spreadsheet. If you have a third-party property management company to run this property for you, they have to agree to your business plan. Okay, you put a stainless steel fridge, you're going to get $200 rent bump? Maybe not. So is it an amenity that the resident is willing to pay for? And is that reasonable for that local market? Because the property management company you hire should have experience in that local market. That's super important to figure out. Another important assumption is in Texas, your property tax can make or break a deal. So you need to have a tax protest company look at that property and say, okay, this is in Dallas County, or this is in Johnson County, or Denton County. This is what you should expect for your tax increases to be. And they should give you that projection for the next 3-4 years of your hold period. And you put that in there. You also get an insurance quote, plus from an experienced insurer who's insured in that particular area, because there are so many nuances to, coastal areas, parts of Florida or Houston versus Dallas, etc. So you need to know an insurance carrier who's been serving that market for a while, because then they have a pretty good idea what your increases are going to be like. Because your taxes and insurance are both your non-controllable side of expenses that still count towards your net operating income. Very important to get those two numbers from neutral third parties in terms of the annual increases that you project in your analyzer. Your rent increases, your rents for those types of units per square foot, right? A 1-bedroom versus a 3-bedroom. What's more popular based on your demographic there? Who are you really targeting? Are you near a lot of employers, industrial areas, a lot of single guys and wanting the 1-bedrooms versus families moving in together? You've got pools, etc. So you've got to really analyze that and have a property management company give you those numbers. And then the big piece that's still remaining in that analyzer is your lender. So your lending terms in your term sheet. If you're going for a floating rate bridge loan, guess what? Your lender might give you a nice term sheet today, but 45 days from today, when you're getting ready to that closing, the proceeds may be different. Your interest rate might be different because it's not something you can lock in today. Versus if it's a Freddie Mac loan, like the last two deals we did in 2022 for both Freddie Mac loans, we're allowed to lock in our rate 6 weeks ahead of time in what's called a good faith deposit. So by the time we get to a webinar stage where we present the deal to investors, we can say, hey, we've locked in 4.56 interest rate. It doesn't matter what the Fed does. This is our interest rate. I know exactly what my mortgage payment is. And you can say that with confidence. But if it's a floating rate loan deal, and we're talking, let's say, a $20, $30 million kind of deal, and a week prior to closing, your lender says, oh, guess what? Interest rates went up. So I'm going to reduce your proceeds by about $1 million. And so assuming that sponsorship team can come up with that $1 million last minute, your leverage still has been reduced now on the deal. So your returns are accordingly reduced as a passive investor. So that's why there's a lot more risk and uncertainty when you deal with floating rate bridge loans, especially in today's market in April 2023. You want to make sure your returns are accordingly better. The higher the risk, the higher your returns need to be. So just by default, if everything else is equal, a floating rate loan deal versus a fixed rate loan deal, I'm expecting a better reward for taking on that additional risk.
There's a ton of extra risk. And Roger, you want to tell her that, she's talking about debt service coverage ratio. That's a term that's near and dear to us as we underwrite these things, right? Tell her a little bit about the huge discount we got just a little bit ago.
Oh, sure. This was a while ago. And what we did was we were purchasing a property. And although we had a cash backup on a cash purchase on the actual, it was a sixplex in Pocatello, Idaho. You probably know Emma Powell's deal. Mm-hmm. She has a deal that's like 55-ish units. Mm-hmm. And on Poplar Street in Pocatello, we bought a sixplex, and we went in and underwrote the deal. Mm-hmm. And because the debt service coverage ratio was off, we asked for a discount, ended up getting, it was about a 15% discount on the purchase, which was only about $100,000 because it was a smaller deal. But because of the debt service coverage ratio, we negotiated it, saved $100,000, and ended up making really good money on the deal because of that. So it was a good negotiation, and we knew this stuff and got it.
Nice. Congratulations on that.
So Sandhya, what is your goal going forward? What are you doing the next few years?
Continue to operate these deals efficiently, because after the honeymoon is over, right? There's so much excitement built around closing a deal. but after acquisition, to make sure you manage these assets well, to execute the business plan and return money to investors and meet or exceed the initial projections. That's a lot of work. So continuing to get more efficient as an operator, look for all the ways I could be efficient by sourcing materials, economies of scale, et cetera, and ultimately leading to vertical integration at some point when I have the numbers to justify it. That would be my goal. 1 or 2 deals a year, that's it, but larger deals and fewer deals. So quality of time, getting more efficient even with acquisitions. That's my plan in the next 3 to 5 years.
What are some of your favorite ways that you are using to increase operational efficiency today? What are some of the things that you're putting into? For an example, we just bought a small deal that we're going to put solar on. We were paying the electricity, and because of the way they structured the loan, it was a really killer 4.25 or 4.7 loan. But we had to do some energy efficiency, and we decided to put solar on because we're going to make the electricity disappear on that project. So, what kind of things are your favorite?
So increasing revenue in ways that residents want to pay for. So washer dryer connections is very popular. And if your deal already has connections in the units, then supply the washer and dryer, because that's part of their monthly budget anyway, to spend money on coin laundry. Or app-based laundry. So instead of that, if you have it in their unit, they're happy to pay for it. Same with internet or Wi-Fi. If that's something that's necessary for them anyway, they'd rather pay for it through you, which if you can offer it at a cheaper rate. So find ways to add value to residents, who are your customers, in ways that they're willing to pay for. Not just, I'm going to give you a stainless steel fridge, so you got to pay me $200 more. That doesn't really make sense. Same with reserved and covered parking. Is that really an amenity they appreciate or not? Certain properties, the layout, it lends itself to that, and certain others, it doesn't. So you always want to look for ways to increase your revenue in ways that are reasonable to the residents and they can still afford it. The expense reduction side, yes, if we're paying the bills, especially the utility bills, I look for every way to conserve on utilities. So LED upgrades, water conservation, and older properties leak detection systems. Because as soon as that leak is there and your water bill goes up, it could be 3 weeks before you detect it unless it's visible or you can hear it, right? Versus if you put those sensors right at the water meter, then you can sense them faster. So do little things like that to reduce your expenses. We're trying to outsource materials in bulk, like flooring, for example, my vinyl plank flooring. If I can buy it by the pallet and buy so much, it's a lot cheaper. And if I can get it also installed by a contractor with whom I have a deal, then I could get it installed for a fairly low price compared to just outsourcing the entire unit upgrade to an outside company. So some of the make-ready work can be done in-house. And then we're also working with our PM right now to see if we could have floating make-ready folks. So let's say in June, I have 10 units coming vacant, and I need those to be rehabbed quickly because they're all kind of back-to-back. I try to make sure when we renew them or when we do new leases on them, they're staggered a little bit. So I don't have so many make-readies all happening at one time. We also want to make sure the leases don't expire at the winter, the off-peak season as much as possible. So can we do a 13-month lease or 11-month lease, et cetera, as it makes sense? Another interesting thing you could do is you could make your leases all expire on a Monday, because then when residents vacate those units, you have weekday available to go and trash out the units and clean them up, et cetera. So a lot of different little things you could do to increase your operational efficiency, but material costs, always shop around for insurance about 60 days before your insurance expires. You want to make sure you're shopping for it because those rates can go really high and sabotage your earnings because it counts towards your NOI. The same with taxes. We always protest them in Texas. Other efficiencies are, can you make do with fewer personnel by automating a few things and having rotating personnel to assist? Just like at the time that you take over a property, there's a lot more work going on. So the first 3-4 months, you might need an extra pair of hands, or you might only need a porter kind of person rather than a highly maintenance, AC certified tech. You may have a lead maintenance if you have properties nearby who's AC certified, as an example in Texas. That's very important. But you could have, let's say lower pay maintenance staff to do some of the day-to-day work. You could also have your own machines in-house for, unclogging plumbing issues that happen rather than always having to outsource it. So just little things, the suggestions, especially if you take it from your staff, they come up with the best ideas because they see the problems day to day. What can you do to reduce your turn time? That's always handy. So 2 weeks prior to someone's move out, someone's lease expiring, have your people walk those units to make a list of items you need right away for the make ready. So those items are available. So you're not waiting on ordering an appliance and therefore delaying a move-in date.
Very cool. One of my favorites, I was trained by a guy that was just absolutely, he was a tyrant about controlling expenses. I worked for another company that could care less about expenses, and they were more concerned about raising the rent. But one of the things I learned really early on was find out what day the trash company's going to come. I want you to there, and I want you to see how full the trash dumpsters are. And these were big projects, right? And so, we'd have 10, 15 dumpsters throughout the project, and I'd go count every single one of them and see, are they half full? Are they 3/4 full? And then we'd dial back our trash service until we got it to a way to save some money. Ultimately, it ended up we bought a trash compactor for the project, and it took a little bit more time to take care of it, but it saved us, enough that we paid for the trash compactor in what was probably a year and a half. That the savings, and we paid for that trash compactor. So it's very interesting. I apologize. I got a little bit of a cold going on. But it's very interesting when you start to dig into it, how much money you can start to save on these projects, and not only for you and your investors, but they also have a green effect on the rest of the planet too. If we can find ways to reduce trash or reduce our power consumption, those types of things. So very cool.
Absolutely. And every project, I would say, look at the ROI. So if you have to spend $10,000 on an interior rehab and you're going to only get $100 rent bump, the payback period is very long. So especially if you have a floating rate bridge loan and you need to conserve your capital, why don't you just see if you can get an organic $50 rent bump and not do any of those fancy updates and just do a basic make ready for like $2,000 or less.
Very cool. Yeah,
it's little things like that makes a difference. Take the can down the road on your spending.
So, Roger, any follow-up questions?
I think we've covered a lot. I know we could go on for forever. Sandhya is really a wealth of knowledge, but I think we are ready to kind of go into the final phase.
Okay.
We have a list of 4 questions. These are the final 4, and then we're going to ask you. The first one is, what is your favorite business book?
I really like Atomic Habits by James Clear. It's the incremental effect of making tiny improvements every day and then stack good habits together. And if you keep doing that every day consistently, at the end of a year, it's going to be a huge payoff.
I love that book. I'm actually getting ready to re-listen to it on Audible. I've just started a new book yesterday, and now Atomic Habits is my follow-up after that. Sandhya, what brings you happuness?
I love seeing the happy faces of my residents. So we do community activities on a regular basis. Like we just had an Easter bunny out at our property for Easter. And to see those kids running and playing and doing an Easter egg hunt is so fun. Just like we had Santa over for Christmas, and we'll be doing a nice big kickoff for the summer with grill and popsicles by the pool as we open the pool for summer. So hearing children's laughter and seeing happy communities, it brings the whole place together, and neighbors know each other, residents know each other. That's what I love to see at properties.
That's cool. What does your future retirement look like?
A good balance of intellectual activity as well as a focus on health and time with family. So that's why doing 1 or 2 larger and fewer deals as far as the future goes, but having systems in place to where I am more hands-off rather than as hands-on as I have been in these initial years.
I like that. What do you think is the best way to give back?
I like to give back to my communities in the apartments by doing all these resident activities. And when someone has a tragedy, like one of our residence. He lost his wife when she gave birth to their second child. So we rallied around and we did a fundraiser for him to be able to pay his rent for a few months. And we also got plenty of diapers and other gifts for their family, so he could get back on his feet after that huge loss. But that way, we try to be as local as possible in our assistance programs. So even people like my investors, my brokers, etc., donated to something like that. On the personal side, I'm very passionate about math and financial literacy. So for years now, I have tutored kids in the neighborhood for free. And I'm so thrilled to see some of them getting, impressive college degrees that they never would have attempted because of their fear of math. So that gives me a lot of satisfaction.
Love that.
Yeah, we sure appreciate the time that you've spent with us. It's been really, really fun to get to know you and talk a little bit about an industry that I think all three of us here have an incredible love for. We really enjoy, like you said, the opportunity to see your residents progress, to help other people, and the whole industry is just, sometimes it gets a black eye or whatever, but it's really, really an incredible opportunity, I think, to give back and to help people grow and develop. And so we really appreciate your efforts to give the industry a bright spot, and love the things that you're doing out there. Good luck out in Dallas. I absolutely love that market. Roger and I joke about the best barbecue that we've ever had is in when we were in Kansas City, but by far the second best is just a little bit north out of Dallas for me, at least. Some of the best barbecue I've ever had in my life is there in Dallas also. So we're looking forward to coming out and spending some time in your market out there really, really soon.
Awesome. Yeah. Let me know when your travels bring you to Dallas. I'm here to help. And if you want to get a hold of me, I put a lot of content out on Facebook and LinkedIn. Those are the best places to connect with me, and certainly through Roger and Earl. Definitely give me a call if you need help in Dallas.
Thank you so much.
Thank you.
Thank you.
All right. Well, that concludes this episode of Retire Wealthy and Happy podcast. Thank you, Sandhya, for joining us, and we'll see you next time.
Yeah, thanks for the opportunity.
Thank you so much. We appreciate it.
Hope you got value from this episode. And if you have a minute, then take the time to leave an honest written review for the podcast, because we take those reviews seriously, and it'll help us serve you better on the next episodes. And most importantly, be sure to start taking action so you can control your financial future today.